Warm welcome all. Welcome to our special edition of Investonomics, our thought leadership platform, a show in which market experts, industry leaders, and business icons share their thoughts and experiences. Now, today, I have with me a very special guest, Mr. Neeraj Basur. He's the Group Chief Financial Officer of Blue Star. Now, Blue Star is a well-known, established brand, and is India's leading air conditioner brand, and also has a presence in the commercial refrigeration segment. So welcome, sir, to this segment. We all know that last two summers have been a bit difficult for the AC as a segment because of the COVID and the subsequent waves what we have seen. Blue Star in the 9 months have delivered good set of numbers with top line being up about 43%, largely driven by businesses across segment. With COVID wave 3 being milder, do we expect better days ahead going forward compared to what we have seen in the last 2 years?
Firstly, thank you, Pankaj, for having me on your show. It's indeed a pleasure as well as a privilege for me to represent Blue Star. Yes, you're right. The performance that we have reported in Q3 and also YTD 9 months December 21. Has been encouraging, and this is notwithstanding Q1, where we have all been through a reasonably disruptive, phase where the second wave of COVID impacted the sector, the markets, and of course there was a fair bit of disruption which had happened. Q3 in particular, if I were to talk about, we have surpassed our pre-COVID levels of top line, as well as Q3 by far has been our best performing quarter in terms of the standalone profits for the quarter. So it is encouraging, notwithstanding the headwinds that we've experienced, we still continue to experience on the input cost, raw material cost, supply chain disruptions, and the longer lead times to source raw material and components that still carries on. So it's quite encouraging that notwithstanding some of these headwinds, the overall performance has across all the segments. If you see all the three segments that we report our performance, it's been quite encouraging. So what we believe is that the overall market demand is quite. Has been, at least in the later part of Q3, quite encouraging, even though festival season, as probably was anticipated, didn't play out to its fullest potential. Usually Q3 festival season does play out well. It did not, but then later part of Q3 was better. As we step into Q4, we continue to remain optimistic, because this third wave, this Omicron wave, though it did impact overall, I would say, the health as well as in some pockets the economic activity, it was firstly very short-lived, and secondly the impact was far more benign as compared to some of the earlier two waves. So we are now looking forward to getting into the normal rhythm of selling as in line with our normal Q4 sales, which typically starts towards the beginning of March, when the summer season starts to set in some parts of the country, starting down south. And then of course we are also equally hopeful of a fairly positive Q1, because after two successive Q1s where, and you're aware, this is the peak selling quarter for us. And we've kind of have had a situation where FY21 and FY22 Q1 got kind of washed out. So this time around, we're indeed looking forward to having a normal Q1 sales. And we see no reason why the market as a whole should not come back on a normal and a healthy growth trajectory in FY23. And in that context, of course, Blue Star, we have our own aspirations to grow and consolidate our position, and then probably continue on this trajectory of growth that we have witnessed in Q3 and hopefully in Q4 as well.
Absolutely. Sir, in terms of one of the big categories, what you operate as the unitary products, whereas the company offers room air conditioners for residential as well as commercial applications. Now, where do you see this industry or segment sort of growing, and how are you sort of placing yourself? I believe that we have increased our ad spend here to capture more market share. So, how has been the trend up till now, and is there anything more excitement you're sort of looking at, given the fact that we are also increasing the touch points across the country? So, a bit on that.
Sure. So we've been on I would say, a very consciously designed strategy for scaling up our overall, not just top line, but also consolidating ourselves in terms of market share in unitary products. I'm talking about the room air conditioners first. In that context, we did launch almost a year and a half ago a completely new range of products, which we call mass premium. And this range of products is enabling us to achieve not just a larger pool of potential customers, because these are products that are priced. We are in a way addressing belly of the market, and so these products are actually addressing a larger segment of our possible potential customers across tier 3, 4, and 5 towns. So that kind of opens up a larger potential pool of customers. It also has enabled us to scale up distribution, because now, you know what, these are products which are attractive for a larger number of distributors, shops and showrooms, or shops and stores, which are better aligned to sell this range of products. So it's a positive in that sense as well. So not only has our distribution scaled up quite reasonably significantly, so we are now almost touching 7,500 stores across the country, which is expected to further go up as we move along. It is helping us penetrate wider and deeper into the customer base that we are able to serve. Now, a hallmark of these products is, of course, we are price competitive, and we are more attractive in terms of the range that is now offered. All this has been achieved without compromising on the Blue Star quality, reliability, and trustworthiness of the range of products that Blue Star brand is known for. So that is the key differentiator. It's not just the price point which is there. So when as a package the customer looks at these set of products, they find it really attractive. So again, since this product range has done well in the last few quarters, we are again confident that there's no reason why they should not continue to do well even going forward. Market as a whole, to your question, see, this is a market that has a potential to grow on an annualized basis anywhere between 20 to 25%. And with the kind of penetration, so even now, if you see, there's about 7.5 million units being sold a year, which is nowhere near the potential of the market as a whole. So in that context, obviously, if FY23 happens to be a more normal year for the market, market should come back on a normal growth trajectory. And then in that context, we are currently having around 13.2% market share, or 13% in that range. Our stated goal is to take this to around 15% over the next couple of years. So again, we see no reason why we should not be doing somewhat better than the market, at least over the next few years, to not just consolidate the whole, but consolidate our market shares further. On the commercial refrigeration products, which is also part of unitary products business segment 2 for us, again, some exciting things are going on. Firstly, we have deepened our presence across some newer product categories. So our traditional products, just to share with you, you'll be aware, are largely have been deep freezers, bottled water coolers, and bottled water dispensers. But then over the last few years, we have expanded our reach into healthcare refrigeration, supermarket refrigeration products, and these are new products, and kitchen refrigeration as well. So these are new product categories where even in the pandemic period, we've seen some fantastic resonance, especially let's say on the healthcare refrigeration products. And we've had a phase where, of course, now it's no longer throwing up additional demand, but the entire vaccination supply chain did need a complete solutions to be delivered by us. So again, in that category, we are optimistic that as normalcy starts to restore, so the traditional customers for our commercial refrigeration products, so the ice cream manufacturers, QSR restaurant chains, So they will at some point in time, come back on their growth trajectories and probably have a catch-up growth phase as well, because they've been impacted for the last 2 years also. Also now schools and educational institutions, offices are reopening, and these are our customers for some of the institutional products on water coolers. So all in all, again, for this product category, again, we feel good. We feel optimistic that FY23 should be a good year. We see no reason, and summer seems to be again visible around the corner.
So a related question on the same is that, what we understand is that we are taking a capital expenditure of nearly 550 odd crores, largely for the room air conditioner segment.
Yeah.
I think which should probably get operational in this calendar year. And so what kind of, so you already sort of, what kind of market share you would want to sort of chase, say in a medium term with that kind of a capacity? Because overall, it's a sort of a significant capacity addition that we are aiming or we are looking to do.
Yeah, so let me clarify two things first. So firstly, this 500 crore capex for room air conditioner is not planned for FY23 entirely. This will be phased out. So what we are, that's kind of a master plan, you can say. So what we are first prioritizing is around 300 crores, which will happen probably by probably end of FY23, somewhere FY24. So that's first point of clarification. And this capital expenditure also includes our investment, which will qualify into the PLI scheme, because we have qualified for a couple of components where the PLI scheme we will be eligible for PLI benefits, which is part of this. So this capital expenditure, which is in the form of, we are setting up this new factory in Sri City in Andhra, is going to help us achieve greater degree of indigenization in terms of our fulfillment strategy. Basically produced in our own premises. So right now we have 2 factories which are based in Himachal, and of course we also buy certain products from ODM contract manufacturers. So we foresee a shift in that mix where now a greater proportion of what we sell or what we will sell, say from FY24 onwards, will be manufactured by us ourselves. Of course, the import of finished room ACs is kind of almost negligible, or because of the customs duty structure changes that happened a year ago. So this is basically to help change the fulfillment mix and reduce import dependence, reduce dependence on contract manufactured products. As far as the other significant capex, which will actually now get commissioned within FY22 or early FY23, is the second commercial refrigeration product manufacturing plant, which is going to get commissioned in our Wada factory premises. That's almost nearing completion. So probably we are about a month away or 2 months away from getting that commission. That was around 100 crore capex, which is more or less substantially completed. So we don't, we are almost there as far as that plant goes. So that plant is intended to significantly substitute our import dependence, because the range of products that will get manufactured in Wada, the commercial refrigeration products, are currently predominantly imported. So that helps us with greater indigenized share and less import dependence. So overall, this mix will help us become far more attractive as a manufacturer of some of these faster selling products. The Sri City factory, since this is going to be located down south, so you can reasonably expect that we'll be more efficient in terms of our entire supply chain, because we are located close to 2 very good ports in South India. So obviously the inbound material and then the logistics cost and the supply chain cost, of course, and this is since a new factory, obviously it will have its own advantages. So we do anticipate some cost efficiencies to accrue once these plants go live. And overall, of course, this will contribute to segment 2 profitability profile as well.
Right. See, another question is that the Ukraine issue has been sort of troubling markets as of now. And we have seen a sharp rise in some of the commodities, especially say copper, aluminum in the last few months. And it does not look like some of these commodities are going to come down. Now, with such a sharp rise in raw material prices, how are we going to sort of mitigate EBIT margins? Would we sort of look at a calibrated hike, given the fact that peak season of the summer season is ahead of us? So how are we planning to sort of mitigate any kind of a raw material challenges which could crop up going forward?
So I would cover this in two parts. First part is the price increase that you have touched upon, and the other one is, this entire recent developments, let's say the geopolitical equations that have undergone this issue recently. Now, even before this current Ukraine-Russia issue happened, the headwinds on the raw material and component price increases, commodity price increases, has been a real issue for the sector, not just our sector, I guess, consumer durables as a whole and many other sectors. And on top of that, you're aware that there have been shortages on the electronics as well. So all of us have been challenged with these issues, all of, I would say, 21 and part of 20 as well. So in order to mitigate or partly mitigate some of these headwinds, we have taken in 3 or 4 installments price increases, and this started for us somewhere in January of 21. So over 3 installments, we've already taken around 12 to 15% price increases across our key selling product range. Of course, because of market competitiveness, all of this might not have got fully transmitted, which should now happen because obviously everyone else is catching up with the price increases. So that to some extent will take care of, or largely should take care of the overall cost impact that has already happened. Now, you would be aware that for us in this sector, in this particular category, which is room ACs, the procurement lead time is fairly long. So for us to plan for our production for, let's say, Q4 and Q1, the procurement cycle actually starts somewhere in October or November of previous year in Q3 itself, because we need to give a lead time of at least 90 to 120 days for, once the orders are placed and the supplies are received physically by us in India. So fortunately, to that extent, this current geopolitical disruption will not impact us in Q4 because we have ordered and more or less we have received whatever we needed to receive in terms of our raw material inventory. And even our Q1 production is ring-fenced and fully mitigated against any such disruption. It remains to be seen how long this entire current issue continues. So if it is a short-lived issue, anyway, it will be of little consequence because seasonally Q2 and Q3 are lower selling quarters for us. So to that extent, it should not be a major, I would say, disruptive force for at least our sector. But of course, it remains to be closely monitored because at the least, it does impact the currency markets. It impacts the interest rate scenario. It impacts. So there are other, I would say, consequential collateral impacts of what's going on there, which we need to closely watch and then be prepared to respond as the situation unfolds. So that's what we are thinking.
Now, so coming to your another big business, which is the electromechanical project business, which contributes more than 50% of your top line and good portion of EBIT. Now, we have seen your order book increasing by about 4.5% in the last, as of December 2021. Now, in terms of segments, which segment, we have seen good amount of capex being announced by the government in the recent budget, and then there is a hope that the private sector capex also will pick up going forward. So which segments do you see more excitement and how this business overall could shape up going forward?
Sure. Now, we are quite excited with what we have in segment 1, which is actually largely MEP or mechanical, electrical, plumbing projects, as well as, the after-sale service business that we have, and also the central air conditioning equipment sales products that we have that gets grouped in that particular segment. So yes, the order book is looking healthy. So it's about 3,000 crore overall order book that we have in this segment. Of course, if in the corresponding previous year, same quarter, we have a large order, then year-on-year growth may appear to be small. But then overall, the 3,000 crore order book is quite healthy, quite nice for us to take forward. So we've done quite a few things, in order to ensure a healthy pipeline of inflow of orders healthy in terms of the overall customer profile, the customer credit profile, and the overall mix of business that we've looked at. So the segments or the categories within this segment that we are focusing quite deeply on, firstly, is the light industrial, which is a straight I would say the positively impacted sector, where either by way of fresh capex commitments that private sector, even government and private sector, it's going on quite nicely and quite rapidly in the last couple of years. Also because there are several players in the pharma electronics sector, for example, they're taking benefit of the PLI schemes, and then they are announcing they are setting up some of new manufacturing plants. So factories, light industrial clearly is one category that we feel even for the next couple of years, at least sometime, is going to fuel some very interesting projects, which we will, and that's a sweet spot for us as well. The second category in this particular segment is it relates to data centers. Now again, the pace at which digitization footprint is changing across the country, across sectors, notwithstanding and not forgetting the kind of regulatory push that is happening for banks, for insurance companies, and even NBFCs, and this entire need for housing the data within the country. So in all, it is creating a demand for new data centers, and data centers do need some very specialized MEP solutions, which needs a lot of past experience as well. That's one sector or segment which is coming up quite nicely. The third one is relating to the e-commerce expansion, because again, what we have experienced in the last 2 years, the e-commerce distribution has really taken off quite fast across a number of categories, and e-commerce players do need to have specialized warehouses, and they have been committing to larger warehouses across many parts of the country. So those warehouses again require us to step in and offer our service solutions. So that becomes another category within the segment for us to focus on. Last but not the least, government-funded infrastructure projects continue as before, and especially in this budget, you'll relate well. The kind of announcements that have been made on capital expenditure commitments that the government wants to do, which is in the right direction, will also have a rub-off effect positively for us across, whether it's metro rail, whether it is water projects, whether it is government-funded healthcare, hospital, educational institutions. So there's a host of focus areas which governments want to look at, and that will continue to fuel the demand and requirement for. Now, keeping in mind that Blue Star probably is amongst very few large organized pan-India players who offer integrated MEP solutions. So it anyway creates a good differentiator for us. So if you see today, there are very, very few players who will be providing this kind of a specialized MEP focus like we do. So obviously, from a customer's point of view, it makes tremendous sense for them to deal with a company like us.
Right. So I think you have one more smaller segment called PEIS segment. One is how do you see this business sort of taking shape? Largely, overall contribution to revenues has remained the same, though compared to the rest of the two business, debit margin profile is a lot more better here. So any sort of insight you can give us on this business?
Yeah, so this business, I mean, we don't have too much time left, so I'll just try and cover briefly. So this business, we do offer some specialized engineering solutions and we work jointly with a number of overseas principals as well. So we are providing some niche solutions where we design, we implement, and then we maintain the solutions which are needed by the customers of some of these solution providers who may be based out of India, some of them at least. So in that sense, since it is a niche set of products and solutions that we provide, ranging from testing solutions, it ranges from healthcare solutions, and we are also into data security. So just to name a very few for you. So it's a range of things that we do.
Right.
Because it is niche, it is more profitable. And because these are kind of customized and these are all very highly personalized kind of solutions that we give, the scale and size is not very large, but then we do we plan to have, have this part of some of our lines of business in this overall segment scale up faster. So overall, this continues to be a very nicely positioned business segment for us. Profitable, as you rightly said. If you look at the capital employed, it's more or less negative capital employed for the last many quarters successively. So ROCs are the ROC profile is quite infinite in that sense. And since it is not directly related with Blue Star's core competencies of cooling, purification, and refrigeration, this has been housed in a step down 100% owned wholly owned subsidiary called Blue Star Engineering. So that's how it gets its own identity and separate focus areas as well. But it's a very nice business to have within the overall consolidated fold.
Right. So I'm sort of tempted to ask one last question, which is on the tax rate front.
Yeah.
So when do you expect the tax rates to sort of come down going forward for you?
Yeah, so we in FY23 in Blue Star, we plan to move on to the 25% plus surcharge. That slab.
Right.
Because we did have some MAT credits that will get fully utilized in FY22. Blue Star Engineering is already on 25% tax rate, and Blue Star Climatic, which is this downstream subsidiary, which is setting up the new plant, manufacturing room AC plant in Sri City, is going to enjoy the benefit of 15% beneficial tax rate, because this has been set up after that scheme was announced, and we will probably go live before 31st March 23, much before the extended timeline. So but of course the tax impact of Blue Star Climatic will take a couple of years to show up. So pretty much you can say 25% plus surcharge will be an effective tax rate probably from FY23 onwards.
Right. So anything more you would want to sort of share with us?
Oh, well, I think you've asked all the relevant questions quite effectively.
Okay. Thank you so much, sir, for the insights into Blue Star. Hope to keep interacting with you in future as well, and wish you and Blue Star the best of years ahead. Thank you so much.
Thank you.
Investments in securities market are subject to market risks. Read all related documents carefully before investing.
Subscribe to our YouTube channel and click on the bell icon to never miss an update from ICICI Direct.